Welcome to Markets Now. I'm Michelle Rook along with Ken Pita with Paradigm Futures. Over in the livestock right now, cattle to the plus side, hogs are mostly lower, and we're seeing some mixed trade in wheat, mostly lower in corn and soybeans. And Kent, let's start off talking about the wheat market because it was the price leader last week. We had a key reversal on Wednesday and then followed it up with a weekly reversal to the plus side in wheat. What do you think? Did we put the low in, and are we putting war and weather premium into that market yet?
War premium for sure. We did have some decent rain in the southern plains, so we took some weather premium out of the market, and yet that rainfall hasn't actually so far given us any major improvement in crop condition rating. So this afternoon's condition rating report, I think, is going to be really important for the attitude of the trade in terms of their assessment of yield potential with this hard red crop. But the war premium, I think we are putting in. There was supposed to be a meeting last Friday. It doesn't appear as if it occurred. I've heard reports that there may be a meeting yet this week. Of course, the deadline is on the 18th, and all appearances from the Russians seem to be that they do not want to extend that corridor unless they get a lot of things that that the West doesn't seem to want to give them right now. And of course, this weekend you saw a pickup in shelling across the Ukraine with drone strikes out of Russia. It just feels to me as though we're going to start to see an escalation of that war, and I'm not sure that the export corridor is going to be able to hold up in the midst of that escalation.
Yeah. Now, since we've had a pretty good retracement, how much further do you think we can push this? Because I think we're getting up into some retracement areas here anyways.
Yeah, we are, and also some resistance on the charts.
True.
You had a really good week, but yet all we really did is get back a lot of the losses from the previous 2 weeks. So I'm expecting that we're going to see a lot of resistance at some of the old highs. We do have to keep in mind that despite the poor crop conditions in the southern plains, the world wheat situation is, still pretty adequate in terms of supply for the world buyer.
Yeah, and the reason that I mentioned the weather premium maybe being put in is because we're going to get crop ratings out this afternoon. And to your point, if we have poor conditions after rain, certainly that might be something that the trade is trying to anticipate here. So I just wondered about that. All right, So corn futures followed wheat last week. We did score a little bit of a reversal there. Some thinking maybe we put a bottom in. Are you in that camp?
Well, yes, for a couple of reasons. Number one, we've extended the size of the speculative short. It's actually now quite large. On the report that goes through the last Tuesday, they had sold over 100,000 contracts just in 1 week, and they're now well over 100,000 contracts short, depending on which commitments you look at. It's very sizable, and there's still some underlying support in terms of the fundamentals that you see with with strong basis levels in the countryside, and a May July and now a July D's corn spread that is getting very, very inverted. So I think what we're going to do is probably see some support on breaks in the corn. I think that the funds will like to use breaks to start to cover some of this sizable short. And then, as we continue to invert the market, that of course means that the December corn futures contract obviously not acting quite as well.
No.
But at $5.25 a bushel, when you consider that the insurance price, essentially a put for the American farmer at an 80% coverage level is down around 470. We really don't have that much weather premium in the corn market right now. And so while we're transitioning to a supply demand balance that's definitely not going to be as tight as the one we have right now, we still have to keep in mind that we got to grow this crop. And, if we have some weather issues, we need to maintain some risk premium for the possibility that it either gets hot or maybe we don't get things planted quite as quickly as everyone thinks what we're going to.
Yeah, we'll see what we get on planting progress today, and then what USDA's frame of mind is as we go into the WASDE report with their numbers on Friday, right?
Yeah, Friday's obviously going to be very important as well. Now you're going to see 500,000 more acres over and above the Outlook conference. We expect yields to be unchanged at 181.5, and then all focus is going to be on the demand side of that balance sheet, right? So you do have a larger, South American safrinha crop that everyone is trying to pencil in, but then again, what are you going to pencil in for exports out of Ukraine, given the current situation there? And what about Chinese demand? That's always another major thing that we're going to be paying attention to. So I think with a 1.8 to 1.9 sort of carry out number that the USDA had at their Outlook conference, personally, I'm not sure that we're going to be a whole lot bigger than that. And if we're not bigger than 1.8 or 1.9, I think that we're probably pretty fairly priced with not a lot of downside and not a lot of weather premium in the market at this time.
We have some of the same factors we're going to be dealing with soybeans, but the difference there is we have a much tighter ending stocks figure coming in, but we've got that big Brazilian crop. So what does USDA do with all of that?
Well, so you have a big Brazilian crop, and then you also have a very hungry Argentina crush facilities that are going to have to take some of that excess. So I'm not sure that ultimately the world balance sheet has as much excess as we're trying to price in with the large Brazilian crop. Keep in mind that U.S. Soybean acres are going to be unchanged on this report. Keep in mind that 52 bushels an acre is real close to record yield. And we didn't actually ultimately end up with an early planting to give us some sort of a boost in terms of yield potential with early planting. So, all things being equal, if you end up with a 275 to 285 million bushel carryout on this balance sheet coming on Friday, you're still reasonably tight on a stocks to use basis, and the discount of November futures down in the 1250 to 1275 area still seems to me to be pretty adequate for the current situation.
Yeah. So let's move over to cattle. We're a little bit higher this morning, but we did have a sell-off, a lower weekly close last week in the futures, lower cash. Market was a little concerned about some of these bank failures. Do you think we can recover this week? Will cash lead us? And even if it doesn't, futures are still at a discount to that cash. Is that enough to
so our expectation is for steady to lower cash here again this week. We did have some late trade Friday at 171 in the Southern Plains. Might see some trade at 170 this week, but your June futures now down at $160, $61. That seems to us to be a stretch for the cash market to get that cheap, given the underlying fundamentals. We think the end user in this market is going to be very eager to buy cattle at any real discount underneath $170. And ultimately, we think that spread between the discounted futures market and the cash is ultimately going to be able to help cattle rebound here in maybe another couple of weeks.
And hogs mixed this morning. We had a down week last week by $8 in the June contract, and regardless of what the problem was, and there was a couple of different factors there, including this talk of sow slaughter. Do you think that we can recover here this week? Do we have enough fundamental reasons to start recovering?
Well, we don't have the fundamental reasons yet. We definitely need to see the cash market take some more leadership. And while cash markets, in fact, in terms of the way the CME measures its index, were trending higher last week. They were not trending higher at the kind of pace that we're going to get us to this premium that the futures are carrying over the cash by the time we get to expiration in the middle of June. So
a big deal.
That's why we ended up selling off in the hogs. We have been seeing slaughter numbers a little bit higher. We're clearly above a year ago in terms of weekly slaughter and weekly pork production, and yet the hog and pig reports are saying that we have slightly less numbers, which kind of translates to this idea that we are getting some liquidation in the industry, and that's putting pounds on the market here on the front end. The cutout hasn't been able to take the kind of leadership that we were hoping for, and in fact, the cutout has been lower here. This was lower this past week. So, all that being said, we anticipate that somewhere in the low 80s that the June hogs are probably going to find some support, and that we ought to be able to have at least some sort of a rebound back, if not all the way to $90 to $92, somewhere up toward that level.
Yeah, disappointing week last week. We just can't get the cash to go up fast enough for the futures to satisfy them. All right, thanks for joining us, Kent Beadle, with Paradigm Futures, and that is Markets Now.